Gold is approaching a notable historical low point, potentially presenting an enticing entry opportunity for investors, comparable to levels not seen since 2018. This situation is driven by global economic shifts, notably marked by China reducing its holdings of US Treasury bonds and focusing less on international trade and exports. Even Japan, a major holder of US debt, is divesting from US bonds as it seeks to exit a 3-decade-long deflationary period. This necessitates converting foreign bonds into their local currency to bolster their domestic economy. Unlike this trend, the Europeans, including the Swiss, are still purchasing dollars, although even the US Federal Reserve is not acquiring new US bonds. This trend reflects a broader pattern of countries prioritizing their currencies by raising interest rates on their government bonds at the expense of others. Globally, we are currently experiencing the highest average real bond yields in the past half-century. However, unlike the 1960s when economies were production-driven rather than debt-based, our modern economy cannot sustain such elevated interest rates for an extended period. In essence, the bond market, especially government bonds, is behaving as if we've reverted to the economic conditions of the 1960s, when wealth was based on production rather than debt. This creates a perplexing situation for Wall Street. Looking specifically at US debt, we observe that the Federal Reserve's aggressive interest rate hikes have disrupted the long-standing bull market in 30-year government bonds, a crucial element for the US economy's stability. Consequently, stocks and bonds no longer serve as reliable hedges against each other. Since 2022, both stocks and bonds have experienced significant declines due to the incongruity of the latter with economic reality. This has rendered bonds, previously considered a safe haven, into a financial uncertainty. The events of 2023 represent a rare occurrence that happens roughly once every half-century. When an asset or market follows an irrational trend for an extended period, economic fundamentals eventually reassert themselves, often leading to a tumultuous correction. These infrequent moments present unique opportunities for investors, as they force Wall Street to react in a predictable manner. Either the market will need to find compelling reasons to reassess the value of assets like stocks and bonds, or governments and central banks will need to intervene. This situation has implications for gold as well. We are at a turning point that will likely reverse the prevailing downward trends in various assets. However, while other assets have already reached their minimum points in recent weeks, gold is just beginning this process and has yet to hit its bottom. Given the historical uniqueness of this downward trend, the gold price bottom will not be ordinary. Hence, this is a significant moment for those considering gold investments, akin to the circumstances in 2018. In March 2018, the market anticipated continuous rate hikes by the Federal Reserve, resulting in rising bond yields and a significant drop in gold prices, which hit a historic low of $1,180 per ounce. Only when the Fed changed its rate hike trajectory did gold start to climb. In summary, as we witness the Federal Reserve's struggle to control the forces of deglobalization, it becomes evident that the era of restrictive central bank policies is drawing to a close. When these policies become a distant memory, all assets are likely to experience robust rallies. However, for these rallies to occur, assets need to reach crucial lows. Stocks and bonds may have already touched these lows, but gold is on the cusp of completing its descent. When it does, it will reach a historic low, providing an opportune entry point that may not reappear, reminiscent of the $1,180 per ounce level seen in September 2018. Thanks for watching.